Welcome to Investors Insights. Our topic today, the Fed on the move. I'm excited to have this conversation today. I came out of a great meeting with my colleagues, Ty Miller and Trey Booth. Thoroughly appreciate their research and efforts. And I just want to encourage you that as we move forward here, not only to see these blogs as we're doing them here today, but to go back and look at some of the information we've already provided. I think you will see some trends that we've emphasized over and over again over the past weeks. That said, the Fed on the move, big week, as we start to look and see what the Fed's going to do on their next decision. Trey, you gave us some great insight. You've done an outstanding job tracking it. I know we've had clients forwarding these vlogs to others as you've commented as they look at mortgage rates and bonds and yields across the board, as well as the movement of the stock market. Talk to us about Fed on the move. What do you think we're going to see here?
Yeah, thanks, Greg. So we used that. I chose that topic because we have been talking since July of 2023. That's the last time the Federal Reserve changed interest rates. Since then, it's been flat. And on these vlogs, if you look back, we have often said the Fed will not move. The market has started the year, priced in 6 rate cuts for 2024. Up to this point, none have happened. Finally, we believe the Fed will be on the move. They're going to meet this week and announce on the 18th their decision. And what is the unknown isn't whether or not they're going to cut rates. It's whether they're going to cut rates 25 basis points or 50 basis points. And so what happens once the Fed starts cutting rate? That's what's very important to markets. It's not that the Fed is cutting rates. It's why the Fed is cutting rates. It's so important. Traditionally, there's 2 ways this can go. The most common way this goes and what the market is pricing in, the market is currently pricing in the Fed cutting from 5.5 all the way down to below 3 and just pretty much a straight line. And then it just cuts until it gets to what is a more normal rate. That lines up with most Fed rate cutting cycles where the Fed cuts straight down. The trouble is that usually comes with a recession. So there's the recessionary Fed cutting cycle or what's called the soft landing, where the Fed cuts and then can pause because they bring down inflation, and the economy slows, but not to a recession. So then they can pause and stop. So that happened. You can see in this chart I'm going to show you is in 1984, the Fed was able to cut rates and then stop. And then their next move was actually higher to slow the economy down again and fight inflation. And then again in the mid 90s, 94, 95, the Fed cut rates, paused. And then actually the next move was higher. And so interest rates in 95 moved from above 6% down to about 5% and stopped. And so many market participants are expecting that interest rates are going to go back to what they were from 08 to 2020 of 0% Fed funds rate, 2% treasury rates, and a 3% mortgage. If we do that, that's an indication of a recession. If we get what most people would like is a soft landing, you're going to see rates lower and then a pause. You look at 2000, 2006, or 2008, and 1990, the Fed did cut in a straight line, but that was not good news. And so it's not just what the Fed does, whether or not they cut rates or how much, it's also what they project that they are going to do going forward. And if the Fed starts talking that they're going to do continuous rate cuts, that's not necessarily a good sign. That may help people that are looking for a new mortgage get lower rates. But if the Fed sees some weakness and is cutting in that continuous cycle, that's a sign of a slow economy. And that's not typically a good thing for markets.
Yeah, and it also doesn't help savers in terms of the money markets, the CDs, those kind of things. We've been fortunate to have where you actually had money markets paying interest.
That's right. There's 2 sides to every interest payment. One person's payment is another person's earnings, and
Exactly.
The money doesn't just go into the ether. It goes from you sometimes through the banking sector into an investor's pocket. And so
Yes.
what's good for borrowers is bad for investors, and vice versa.
Yes. Yeah. Well said. And Ty, you also added to that because you started talking about bonds, and so often people are asking us about the equity markets. Interest rates impact stocks, and they also impact bonds. So talk about that in relation to what Trey's shared with us this morning.
Yeah, that's correct. As the Fed gets here, ready to cut, we always emphasize the importance of diversification in our industry, of course. And one way to diversify is have a mixture of fixed income or bonds and a mixture of equities or what we call stocks. And so, there are other ways to diversify, of course, and we know that that's been a little harder, especially in the equity market, as you've seen, Mag 7 outperformance. Well, you may not realize that, as we've gone on through this year, not only have we seen some diversification in the stock market where some of the companies outside the Mag 7 have started to perform better and the equal weight S&P is doing well, but also in the bond market. From 2000 until 2020, bonds were a great hedge against stocks, and they were not correlated. Now, since 2020, since COVID, they have actually been correlated. And I'm going to kind of go into what correlation is. Essentially, correlation can range from 1 to -1. And 1 would be perfectly correlated, meaning if stocks were up 10%, you would expect bonds to be up exactly 10%. And -1 would be perfectly uncorrelated, meaning if stocks were up 10%, you would expect bonds down 10%. 0 would be no correlation whatsoever. They don't move in kind whatsoever. And so, as I alluded to, from 2000 until 2020, bonds were negatively correlated to stocks, meaning they were a good hedge. If the stock market was down, bonds would be up, and vice versa. Just a general rule of thumb. It doesn't always work that way, but general rule of thumb. Since 2020, since COVID, with all the inflation we've had, you've actually gotten pressure from stocks and bonds. Think of 2022 when both were down. And so now we're starting to see a more normalized period like we saw from 2000 to 2020. And that's something that, provides a lot of optimism here. If stocks happen to be down, you're actually getting some return on your bond portfolio as well. And the Fed cutting rates is going to help that, because as the Fed cuts rates, bond prices will go up. So that's just another way to diversify and something kind of more return to normalcy in the markets.
As I said in my earlier comments, we got some big things going on here as we watch the Fed and what the rippling effect is of that decision. So stay tuned with us as we continue throughout the week of social media on Facebook, LinkedIn, Twitter, on our podcasts, YouTube. We want to provide you as much information as possible. We thank you for all your questions that you continue to send us, and we want to address these topics. We're positive about what we're seeing, and we're looking forward to keeping you updated. Have a great week. Thanks.